Every single trade I take starts here, not on the lower time frame, not at the entry. It starts with my daily bias. And I know that sounds cliche because everyone says that, but most traders either skip this step completely or they do it halfway, and then they wonder why their entries keep failing. Because without clear bias, you're basically just guessing. You're taking entries without any real reason to be in the trade. So in this video, I'm going to walk you through exactly what I look at before I touch a lower time frame chart. And by the end of it, you'll have a clear pre-session process that you can apply every single day. Alright, so if you're day trading, which is what this whole system is built around, your starting point should always be the daily time frame. And the first thing I'm asking myself every morning is very simple. Where did price close yesterday, and what does that tell me about today? More specifically, I'm looking at the previous day high and the previous day low. I want to understand which side price is more likely to target. So for example, here we have a bullish close. Price closed strong, and this tells me that there is a high probability we continue higher and eventually reach the previous day high. And in the bearish example, it's the opposite. We have a bearish close, so my expectation is that price is more likely to trade lower and reach this previous day low. Now, the reason these levels matter so much is because they act as liquidity targets. There are stop losses sitting above the previous day high and below the previous day low, and price naturally moves towards liquidity. So that's the narrative behind this whole idea. So the way I personally read it is this. If price closes above the previous day high, that tells me that buyers were strong enough to displace through that level and actually hold above it. And if buyers were able to do that, then my expectation for the next day is a continuation higher. And the same thing on the downside. If price closes below the previous day low, then I'm leaning bearish, and on the next day I'm looking for a continuation lower. But this is where it gets important. If price tries to close above or below one of these levels and it fails, meaning it pushes through it but it can't hold the close and actually closes lower, or in this case higher, my bias here can change. Because if price couldn't maintain acceptance above or below the level, then there probably wasn't enough conviction behind this move. And this failure alone is information, so I'm not going to ignore it. So every morning before I even touch a lower time frame, I'm looking at the previous day candle and I'm asking, did we close above the high? Did we close below the low? Or did we fail to hold? And the answer to that question becomes my first filter for the day. Okay, so let's look at this first example. Here we can see that we closed above previous day high. So what we are expecting from the next day is a continuation towards previous day high and a bullish continuation. And as you can see, we get it. Now, we closed above, so we are expecting price to trade into this previous day high and trade higher. Now, you can see that we sweep this high and we fail to close above it. So here in this case, we can switch our bias and we can lean toward a bearish side. So we are expecting price to reach here and trade lower on the next day. Here you can see we closed below. So same process, we are expecting price to trade into this level and close below. And here we are again, same process, we are expecting next day to be bearish, trade into this previous day low, and as you can see, we get down. And we can do the same process over and over again for every single day. So as long as we are respecting these closures, price should keep going in the same direction. But when you see these sweeps, that's when we change our bias. Now, once I have my read on the previous day, I zoom out a bit and start looking at the bigger picture. And this is where two important concepts come in. External range liquidity, ERL, and internal range liquidity, IRL. External range liquidity is basically the obvious highs and lows that are sitting outside the current range. For example, previous week high, previous week low, or major swing highs and lows. These are areas where stop losses are resting. And because price naturally moves towards liquidity, these levels can become targets. Internal range liquidity is a little different. This is liquidity sitting inside the current range. So, for example, for value gaps, imbalances, or inefficiencies that price hasn't revisited yet. And the idea is quite the same. Price often wants to come back rebalance those areas, and then continue. So when I'm building my bias, I'm constantly asking myself, where is the nearest draw on liquidity? Is there an ERL above that the market is likely reaching for? Or is there some liquidity sitting below? Is there an unfilled fair value gap that hasn't been tapped? Because once I understand where price is likely being drawn, I start understanding not just the direction, but the reason behind the move. And this is where things start getting really interesting. Because once price actually reaches one of these levels, for example, an ERL or an IRL, my focus shifts. Now, I'm no longer just tracking the draw on liquidity. Now I'm watching for signs of reversal. So did price sweep the liquidity, and do we have a reaction? Did we displace away from the level? Is, for example, a swing starting to form in the opposite direction? Because if price reaches one of these areas and fails to continue through it, that tells me that this level is being respected. And once that happens, I can anticipate a reversal in the opposite direction, and I can potentially trade from it. Okay, let's look at this example. We have an ERL sitting here above, and we can use it as a target. So we can see that price closed above previous day high, so we can expect a continuation higher. We get that continuation, we close above, and now we still have to hit this liquidity. Now, we hit this liquidity, but we failed to close over. Instead, we closed below. So here we can expect a reversal from this level. Liquidity has been taken, and now a potential move lower can happen. So we are leaning bearish, we get this bearish closure, and now there's another ERL sitting here. So we can expect a continuation lower again. Now we close below, and here we hit again our new external range liquidity. Okay, so let's go over this example where we can see how to use fair value gaps as targets. So once this candle closes, we have a fair value gap here. And we also have an external range liquidity sitting down there. So we're gonna most likely sweep this first and then head towards this fair value gap. So as you can see, we sweep previous day low, and we can switch bias to the upside. We still have our target open, and we are leaning bullish. And in this case, on the next day, you can anticipate that we are gonna trade into this fair value gap. So you can use this as a target. Okay, in this example, we can see how we can use fair value gaps as points where to reverse from. So in this case, we have this candle, which is forming a swing formation to the upside. So here we can anticipate that price is gonna move higher. And as you can see, we get a bullish closure. So again, we can anticipate price to move higher, potentially towards this external range liquidity. And on the next day, we actually reach the target. So now let's put everything together, because this is where the pre-session process actually starts becoming useful. Every single session, I go through this in the same order. First, I look at the previous day candle. Did we close above the high? Did we close below the low? Or did we fail to hold it? That gives me my initial directional idea. Then I zoom out and look at the bigger picture. Where are the PD arrays? Where are the previous week highs and lows? Where is the nearest draw on liquidity? So where is price most likely trying to go? And then I ask myself one simple question. Do these things agree? So for example, if the previous day close is suggesting a continuation higher, and I also have an ERL or a fair value gap sitting above, this is alignment. Now I have multiple reasons supporting the same direction, and that gives me confidence in my bias. But sometimes they don't align. Sometimes the previous day candle is suggesting one thing, so a bearish closure, and the higher time frame structure is suggesting something completely different. And when this happens, my bias isn't clear enough, so I don't trade. And that's not hesitation or indecision. That's discipline, because there will always be another session, there will always be another setup. And honestly, this is one of the biggest things I want you to take from this video. Building a bias does not mean forcing yourself to pick a direction every single day. Sometimes the correct read is that the chart simply isn't giving you enough information. And in this situation, the best trade is not trade. Alright, let's go over a couple of examples so we can put everything together. Here we can see that we swept previous day high and we closed below previous day low. So on the next day, we can expect a continuation to the downside. Now we get that continuation, but at the same time, we tapped into this fair value gap. Now we cannot anticipate our reversal just yet. We have to wait until the next day for a confirmation, or the next day can simply close below this fair value gap and invalidate it. So we have to wait. On the next day, we have our confirmation, we have our swing formation, we have this closure above previous day high, so we can anticipate price to move higher. And also we have this new high right here, so price is likely gonna reach down. Now on the next day, we have our continuation to the upside, and again we closed above previous day high, so we can expect the next day to move higher. And as you can see, we reached the target. Alright, let's go over this next example. Here we can see that price swept previous day high and failed to close above it. So in this case, we can expect a reversal, a continuation to the downside. And on top of that, we have this external range liquidity sitting down there. So price is likely gonna move towards that liquidity. On the next day, we see a bearish closure, confirming our bearish bias. And on the next day, we are still leaning bearish. So we are expecting price to reach previous day low. Let's see if we sweep it or if we close below it. We close below it, so we can expect the same thing from the next day. Again, we close below it, so we are still bearish. As long as we keep holding these previous day lows, we are still bearish. So again, we are expecting price to move lower. And here we tap into this external range liquidity. So let's see if we're gonna create a swing formation or we keep moving lower. Alright, so here we can see that price tapped into this fair value gap right here. We get this swing formation right here. So at this point, we can expect price to move lower because we have a C2 closure and a swing formation. We are closing bearish, we are not closing below previous day low, so let's wait. In this case, we are closing below previous day low, so we are leaning bearish again. And here you can see we get a continuation. Before you look for an entry, you need a reason to be in the trade. And that reason has to come first, before the lower time frame, before the setup, before any of it. Because a lot of traders use entry as an excuse to trade. They want to be in the market, so they drop to a lower time frame and they start to look for anything that looks valid. And that's how you end up fighting the market instead of reading it. If your bias isn't clear, that's not a sign to go lower and force something. That's a sign to wait. The entries will always be there, the session will always come back, but forcing trades without a clear bias is just gambling with extra steps. Build a bias first and everything else comes after that. And if you want to see how I take this from bias all the way to execution, the entry rules video is linked right here. And that's the next piece of the puzzle. And if you're not subscribed yet, hit the subscribe button and turn your notifications on so you don't miss the next one. And if you want the day-to-day content, come find me on my Instagram at Sierra Trades. I'll see you in the next one.